welcome to Sectors Up Close. I'm Elena Casas. Today we're talking about the oil market, and my guest is Viktor Katona, lead crude analyst at Kpler. It's a year this Friday since Russian troops invaded Ukraine and the West began its attempts to squeeze the Russian economy. Energy prices skyrocketed and oil and gas escaped sanctions for months. In the first month of the invasion, Russia was making €1 billion a day from energy exports. Germany alone has bought €24 billion worth since the invasion. Europe is now playing catch-up. An EU ban on the import or transfer of Russian seaborne crude came in on December the 5th, along with a G7 price cap of $60 a barrel. Ships carrying Russian oil now can't get insurance and their owners can be sanctioned. Russia has fired back by cutting output, threatening to cause another global price spike. Last week it announced plans to cut production by 500,000 barrels a day, or 5% of its output. Well, how has that affected the global price? Brent crude spiked over $120 last spring, fell as low as $76 in December after the cap was introduced. In comparison, the average price of Urals crude in January, going to buyers like China and India, was just under $50. So the cap hasn't dried up supplies, but nor is it making much of a dent in Russia's profits. What's next then for the oil markets? For more, I'm now joined by Viktor Katona, lead crude analyst at Kpler. Viktor, hi, thanks for joining us. Let's start then with those recent production cuts announced by Russia. Does it have much power to affect the global supply and price by cutting back in this sort of pushback against the cap?
Well, the problem really with the production cut is that everyone expected it. And that's why it never really had the result or the effect that a lot of people would have expected on the Russian side. Ultimately, the production cut is not even driven by the oil side, but it's very much driven by the products, because Russia has withstood the first oil price cap and the EU imports ban on crude relatively easily, thanks to India and Asia. Very much rerouting everything that they used to go to Europe into Asia. However, with products, it's an altogether different story. Placing it in saturated Asian markets, I mean Russian products into saturated Asian markets, is a much more difficult thing to do. And finding new market outlets would actually take months, if not years.
You mentioned the sort of development of almost a parallel oil market in which Russia is selling crude to India and China outside of the G7 sanctions system. What effect is that having on global oil markets?
It effectively creates a two-tier system whereby you have one very coherent Brent/WTI market, which are increasingly interlinked. WTI is getting into Brent pricing and inevitably will end up defining Brent pricing very soon. And then you have the Asian market, which is almost entirely separate in the sense that you have Iranian flows, which just go under the radar. You have Russian flows, which dominate the Russian exports and yet have very little immediate impact on pricing overall. So it definitely has an impact. The fact that Russia is selling its oil into Asia and effectively is out of Europe altogether has an impact and just widens the discrepancy between wherever Europe stands right now and where Asia stands. In effect, Europe is becoming WTI dependent, and Asia is increasingly growing to be a separate region in terms of how it feels about its own supply and demand balances.
Does that mean that the impact of the Chinese economic recovery and growing demand there on the market for Brent and WTI is going to be muted if Chinese refiners are buying a lot of those imports from Russia?
In a sense, yes. There is a high risk that the incremental buying from Chinese refiners, be that in Russian volumes or in Iranian volumes for that matter, or Venezuelan volumes, there's quite a selection at the moment, that it might not necessarily reach the market signals. and will not trigger such an immediate reaction in terms of outright prices. In fact, we actually price that in. We don't really expect oil prices to go up until $100 per barrel this year, but we think there's going to be a much more muted incremental growth upwards as basically China comes back into the global markets. And 90 is the new norm, not 100, not 130, but it's because the market signals kind of disappear from the market with quite a gray stream of crude taking place. It's inevitably having an effect.
Finally, Victor, if the US and EU do try and push down this price cap on Russian oil and make the Russian economy suffer further, is there a point where Moscow might decide it's no longer worth extracting it and pull the supply from the market? And what would that do?
I think that effectively both sides, the West and Russia, are satisfied with the status quo. Russia is satisfied because there was never really a systemic disruption to its production. Russian oil companies are satisfied because they have a huge amount of money in the transactions having the crude delivered into India or China, which the Russian government doesn't tax. So for them, it's good because they effectively control the shipping and the insurance side. The West, on the other hand, is satisfied because the Russian government has less revenue. Not necessarily the Russian companies. The Russian companies are actually quite well off and enjoying themselves. But the Russian government is definitely seeing the prices that effectively the price rating agencies are seeing. So not punishing the Russian oil industry, but punishing the Russian government is actually a quite constructive approach to the sanctions, because it keeps the industry alive, but then again, restricts the amount of money available to Moscow.
Insight, Viktor Katona, lead crude analyst at Kpler. Well, that's your roundup of the oil sector. I'm Elena Casas, and this is Reuters.